Okay, folks, it's time and I'm going to get started. Any questions before we start? Is that your DCF, if you want, I think about a third of you or maybe 20% of you have turned in your DCFs already. And for the most part, I've returned them. The ones that came in after midnight last night, I haven't had a chance to look at. But you could turn it in. I'm going to extend it through Sunday because it turns out that this weekend I have family commitments. I'm not going to be able to look at them. So if you want the extra week, the weekend will make a difference for you. So if you need until Sunday at, whatever, you can take it until Sunday, because if I'm not going to look at them, why make this arbitrary deadline of Friday at 5? So, take the weekend, and if you can turn in your DCFs with my perfect DCF in this subject, I'll get it back to you as soon as I can. Any questions before we start? Okay. So let's do the start of the class test as always, because that's a good place to kind of look at what's coming today. One of the things we're going to talk about today is banks. Yeah. Let's say you're valuing a bank that is conservatively capitalized, which means it's got a lot of regulatory capital and it's much higher than the minimum. And you're saying, look, I want to reflect this somewhere in my valuation, that it's a nice, safe bank. Which of the following would you expect to see in the company's fundamentals? So it's actually overinvested in regulatory capital. What are you going to see? And I'm not saying this is true for every company like this, but most companies like this, what combination are you going to see? High return on equity, low risk, low return equity, low risk, high return equity, high risk, low return equity, high risk. So let's break that down. If you've overinvested in regulatory capital, what are you more likely to see? High return on equity or low return equity?
Low return on equity.
Low return equity, because you put in more into your base. So you should expect to see lower returns on equity. But by having a higher regulatory capital ratio, you're also less risky as a bank. You're far less risky to hit those disaster scenarios. So this is a company that you would expect to see have low return on equity and low risk. In contrast, if you're a company that skates on the edge of regulatory capital ratios, you keep your ratio at the absolute bare minimum. You might even cheat and keep it below and make it look like you're at the minimum. Here's what you're far more likely to see. You're far more likely to see high returns on equity. But if you're not careful and miss the risk, these are exactly the banks you end up buying because they look good. One of the things we're going to talk about today is digging a little deeper into banks, understanding what it is that drives returns and risk, because if you're not careful with banks, you can end up with some of the riskiest banks looking cheap to you. Now, for many of you, since you've already valued your company, this might be a good time to ask you a question about what you plan to do with that value. So let's say you valued your company, and you could pick whatever your company is, and if this is true for your company, make it your case. Your value is much higher than the price. In fact, you're certain about your valuation. Don't ask me how you got to that point, but you feel absolutely confident that you got the value right, and the price is lower. Would you put all your money in that stock? Assuming your confidence is well placed, what's the risk that you still have not covered? You could be right about value. The price is much lower than the value, but for you to make money, what has to happen? The price has to adjust to value. Unless you feel confident about both things, you can't concentrate your portfolio. I've kind of talked about this earlier, but this is a good place to kind of talk about concentration versus diversification, right? There's this whole group of investors. Mark Cuban, Charlie Munger said recently that you'd have to be crazy to own more than 3 to 5 stocks in your portfolio. Let's take them at their word. They're saying buy 3 to 5 stocks. What are they also implicitly then telling you? That they're confident about their valuations of these stocks, and they're confident that the market will correct its mistakes. I don't know where they get their confidence. My problem with concentration is not that it never works, but you need incredible confidence on both your value and the market for this to be true. I don't have that confidence. So when people ask me why I diversify, whether it's, they say, if you feel that strongly about intrinsic value, why don't you just put your money in 3 stocks? I can feel strongly about intrinsic value and not feel that the market is going to correct its mistakes in the near future. And if that's the case, I need to diversify. So when you put that buy recommendation on your company, remember, it is going to become part of a portfolio. You don't have to feel 100% sure that it's right, because the more you spread your bets, the more you can afford to be wrong on a few of them and still come out ahead if you brought something to the table. So today we're going to talk about the last few aspects of the dark side of valuation. So let me start with banks. I didn't mean to do that, but hopefully it'll come back. So let's start with banks. Now let's think about the 4 questions. Sorry, I'm going to go back to the reading. Do the slides, it kind of darkens my screen here too much. So let's look at the 4 questions. What are your cash flows from existing assets? What's the value of growth? How risky are you? When will you be a mature firm? Right? Pretty standard questions. Let's ask those questions for a bank. What are your cash flows from existing investments? How do we usually compute cash flows? We start with earnings, then we add back depreciation, we subtract out CapEx, and we subtract out change in working capital, right? You want to try that for a bank? Try it. The earnings you're going to get, but then you're going to say, what's depreciation, what's CapEx, what's working capital? For a bank, it's everything or nothing. Getting or even estimating cash flows to a bank is close to impossible. You say, what's the value of future growth? Well, again, you run into this problem of how do I measure what's invested in my project? You can't measure what's invested. How do you come up with a return on invested capital, a return on equity? If I asked you, is this bank doing well or badly, you kind of wave your hands and say, I don't know. How risky is this bank? And here we went into a Faustian bargain. With banks, we don't even look at the risk because we assume the regulatory authorities will make sure that they don't become too risky. I'll make a confession. When I wrote, in fact, every valuation book I wrote pre-2008, the chapter that I had on valuing banks started with a statement that I've never, ever been able to live down. You know what the statement was? Valuing banks is easy. And it was built on 2 assumptions. The first was that banks were run by sensible people. You see why that assumption has to hold. And the second was that the regulatory overlay actually worked, that it kept banks it basically kept them from taking risks that were too big. You're saying, how does that help me? If banks are run by sensible people and you cannot estimate cash flows as an equity investor, remember with the bank, all that matters is equity cash flows. If you cannot estimate cash flows to equity, but if banks are run by sensible people, you know what we tend to assume? That what they pay out as dividends is a good measure of what their cash flow to equity was. It's trust. We trust banks to pay out what they can afford to in dividends. You're saying, but couldn't they be taking a lot of risk? That's where the regulatory assumption comes in. If you assume that regulatory overlay works, you can't have a really risky bank because the regulators sort of stepped in and stopped it from happening. In a long-winded way, you know what I'm telling you, right? The way people used to value banks the way I used to value banks until 2008 was I used to use a dividend discount model. It was the last sector in the market where I still stayed with dividend discount models. So I'll give you an updated example of how this would work with a bank, a dividend discount model valuation. It's with an Egyptian bank called CIB. It's a valuation I did probably 2015. And I decided to value CIB. It's a very well-regarded Egyptian bank, lots of money, making lots of money, high return on equity. I valued it using a dividend discount model. And a dividend discount model, to value the bank, you've got to project out expected future dividends. And here's where I started. I looked at what they paid out as dividends in the most recent year. They had 4.04 Egyptian pounds as earnings. And they paid out about 25% of that as dividends. That was last year. I'm going to assume that for the near term, at least, they were going to continue to maintain that payout ratio. So they're going to pay out about 25%, reinvest about 75%, and they will maintain the return on equity they had in the most recent year, which was a sky high number, 42%. Now, before you get too impressed with that number, it's in Egyptian pounds. You're saying, so what? The inflation rate in Egyptian pounds is much higher. So 42% return is high, but it's not as high as it would be if it were a dollar return on equity. Now, of course, when you get returns on equity this high, the question you always ask is, hey, how are they able to make these returns? It turns out in Egypt, there is not much competition. The domestic market is controlled by a few banks. And because they control the domestic market, they have pricing power. They can set interest rates on loans at whatever number they want. So this is a high return on equity bank. And if you reinvest 75%, your expected growth rate in earnings and dividends is going to be about 32%. So here's what I do. I take the earnings and I project them growing at 32%. I pay out 25% of those earnings as dividends. Very simple, no capex, no depreciation, no working capital. I just take the dividends. But then I stay consistent, which is as the growth rate starts to decrease down to my stable growth rate, which is 10%. That's a high growth rate for stable growth, right? But again, it's in Egyptian pounds. My payout ratio increases, my dividends go up. So I'm still following the rules of consistency, but rather than forecasting cash flows, I'm forecasting dividends. So the next 5 years, 25% payout ratio climbs after that. In steady state, I assume they will earn a return on equity of 25%. Lower than what they're doing now, but still pretty high. And with that payout ratio, with that growth rate and that return on equity, they can afford to pay out about 60% of their earnings. So everything is tied together, my growth, my return on equity, my payout ratio, but my focus stays on dividends. Now I need a discount rate to discount dividends. Dividends are cash flows to equity. So I discount them at the cost of equity. Risk-free rate was 10.53% in Egyptian pounds in 2015. I actually took the T-bond rate and used the differential inflation because there was no Egyptian government bond rate. So I had to do the differential inflation. 2.27% was my T-bond rate. The inflation rate in Egypt was 9.7%. The US was 1.5%. That's a 10.53% risk-free rate. The beta that I use is the beta for banks, not Egyptian banks, but just banks in general. And notice I don't unlever or relever because I don't even want to open that door of debt to equity for a bank. And the equity risk premium is huge. Why? Because it gets 100% of its revenues in Egypt. My cost of equity reflects those choices. So remember I said don't get too impressed with the returns in equity looking so high. The cost of equity is almost 23%. I take the expected dividends, discount them back at that cost of equity. What I got as my present value of dividends, and of course the terminal value, is about 42 Egyptian pounds per share. The stock was actually trading at 36 Egyptian pounds. This is the old-fashioned way to value banks. Take dividends, discount them back. But taking dividends means you still have to be consistent. You got to allow for changes in payout ratios, the growth changes, but you discount the dividends and you're done. You don't add cash, you don't subtract or cross holdings, minority interest. None of those things matter because dividends are your ultimate cash flows and they incorporate everything you own as a company. And the reason, again, we use the dividend discount model is there's so much we don't know with banks. And this is the Faustian bargain. In return for them being regulated, they were able to get away revealing very little about themselves. Yesterday, I actually got an email from somebody valuing an Indian bank, and he said, I know this bank has lots of problem loans. I'm looking through its financials to find out what percentage of their loans are problem loans, and I cannot find that information. And I said, welcome to bank valuation. Because for 100 years, that's what we've allowed banks to do, right? Because the reason we've allowed them to do that is we say that regulatory authorities have access to the problem loans. They will not let this bank continue if it truly had a serious problem. Therefore, we're not going to ask. So estimating cash flows become impossible. We stick with dividends and we hope that the risk doesn't show up as a higher cost of equity. So that was until 2008. You say, what happened in 2008? You know exactly what happened in 2008. We had a crisis which was centered around banks. Doing what? Behaving badly. And what's the first thing we discovered? The regulatory overlay doesn't work that well, that banks were taking risks that the regulator doesn't even seem to know they were taking. So there's one half of my trust gone. I don't trust the regulators. And then in the quarters following, here's what we saw banks do. We know coming out of the crisis that 90% of banks were badly damaged. Regulatory capital had been dropped down. Every one of these banks knew that they had to bring regulatory capital up. And if you are a sensible banker, you know you have a regulatory capital problem. What's the first thing you should be doing with dividends? Because every time you pay dividends, what are you doing? You're in a hole, you make it deeper, right? You should stop paying dividends. But guess what banks continue to do through 2019? Most of them continue to pay dividends. Remember that first assumption that banks are run by sensible people? What I came to the conclusion in 2009, banks are run by some of the least sensible people on the face of the earth. So you don't trust regulators, you don't trust bank managers, there goes your dividend discount model, you can no longer use it. So the question then becomes, what do you do instead? Okay? So if you, let me go back, sorry, I'm going the wrong way, sorry. So I'll come back to the Wells Fargo valuation. So here's what I'm going to do instead. I'm going to try to come up with free cash flow equity. That's a strange thing to say because I've said you can't come up with capex and depreciation and working capital. I'm going to come up to free cash flow equity through the back door. And here's what I'm going to do. I'm going to argue that for banks, book value of equity actually means something. You know why I say for banks, right? Because for most manufacturing companies or technology companies, I don't care what the book value of equity is. It could be negative. Remember, 1 in 9 US companies has negative book value of equity and say, don't worry about it, you can still value the company. With banks, book value of equity matters because it's very closely tied to regulatory capital ratios. This is why banks can't have negative book value of equity. And if book value of equity matters, what you have to invest in that book value of equity becomes your equivalent of reinvestment. And here's how it works. If you're a bank with a 50 million book equity and you want to grow, you need to bring in more equity because without bringing in more equity, you don't have the regulatory capital to grow. So here's my definition of free cash flow to equity for a bank. I start with net income, right? Because I'm looking at an equity cash flow. So that's where I've started any free cash flow to equity calculation. But instead of adding depreciation, subtracting capex and change in working capital, here's what I do instead. I subtract out what I need to reinvest in regulatory capital to keep going as a bank. You think, why would that reinvestment be different across different banks? If you're a high growth bank, you will need to reinvest more than if you're a low growth bank. If you're an undercapitalized bank, you will need to reinvest more than if you're an overcapitalized bank. Remember that question I asked you, if you have an overcapitalized bank, where would you show it in your valuation? This is the place you could show it. So I'm going to take your net income, subtract out the reinvestment you make in regulatory capital, and you end up with a free cash flow to equity. So I'll give you the contrast. We go back to the previous page. This is the old-fashioned model. Wells Fargo just ahead of the 2008 crisis. Traditional dividend discount model. Are you making assumptions? Yes, but the assumptions tend to be limited because you're focusing on a number you can actually see, the dividends paid out. So in 2008, I valued Wells Fargo. I used the traditional dividend discount model, saying, what else can I do? I can't estimate cash flows. And then you get this break in trust. Now, I don't trust banks. I don't trust their managers. I don't trust the regulators. I'm not trusting their dividends. I shifted in 2008 looking to free cash flow equity. And it came with consequences. Because to estimate the free cash flow equity, I need to understand the difference between tier 1 and tier 2 capital. Something I've never wanted to do, but I have no choice, right? If I don't understand how banks are regulated, how the heck am I going to value them? So what I'm going to show you is a bank valuation I did in October of 2016. And I'm sure you've all heard the name of this bank. It's Deutsche Bank. In fact, the blog post I wrote, where the title of the blog post, which I got a lot of blowback from Germany, was a Greek tragedy at a German bank. You know why I picked that title, right? The Germans like to look down on the Greeks and how undisciplined they are and how they do crazy things. And here you have the ultimate German institution, Deutsche Bank, behaving like a Greek bank. I mean, Deutsche Bank reminds me, you know how you watch these horror movies, they usually come out around Halloween, and these horror movies where a person keeps doing stupid things over and over and over again, like walking into dark basements where there are no lights. Through the movie, you say, what the heck are you doing? You're going to get slaughtered sooner rather than later. Deutsche Bank is like one of those characters. Every year it wanders into a dark basement, it gets its hands sawn off, but it never learns. It keeps doing it over and over again. So this was a valuation I did of Deutsche Bank in October of 2016, when it hit a crisis point. And here's what the crisis point was. Deutsche was hurt by the 2008 crisis, but so was every other bank. But most of the banks took losses in 2008 and 2009. Then they came back, JP Morgan, Bank of America. But Deutsche continued to lose money year after year. So starting in 2009, they found ways to lose $1 billion each year for one reason or the other. And every time you lose money as a bank, remember that's coming out of your regulatory capital. So coming into October of 2016, Deutsche was already badly damaged. And then they got one more hit. The Justice Department fined them, the US Justice Department fined them $10 billion for something that they'd done in 2008 that they obviously shouldn't have. You take the $10 billion fine, you put it into regulatory capital, you take it out of regulatory capital, the tier one capital ratio dropped to 12.4%. You're saying, how do I know whether it's high or low? I compared it to the tier one capital ratios of other banks. They were in the 10th percentile or 15th percentile. They were way below where they needed to be. They were losing a ton of money. So this bleeding was not quite done. They were going to continue to bleed. In fact, the crisis was so bad that there were news stories floating around that the German government might have to take the bank into receivership, basically run it as a German business before. That's what happened to the Royal Bank of Scotland after 2008, is it actually had to be removed from the market because it was so damaged and fixed and then brought back. So there's talk that the German government might have to do that, which if you're an equity investor means your equity would get wiped out. So there was talk about that happening. But I decided to try to value Deutsche Bank in the midst of this crisis. So let's think about the magnitude of the problem here, right? They're losing money. So the first thing I need to do is figure out a way to get them to making money. So here's what I assume. I assumed that over the next 10 years, their return on equity would improve. Why? Because they're still one of the largest banks in Europe. They still have a domestic market where they're dominant. I assumed they would find a way to recovery, but I wasn't starry-eyed. I assumed that if they recovered, they would end up with a return on equity equal to the cost of equity. So this is not a dream scenario of the bank making it back to some wildly successful state. I'm just assuming they can make it back to earning the cost of equity. So as their return equity goes from negative to positive, their losses become profits. So basically, I'm just multiplying the return equity by the book equity. Now, as they do this, they also have to bring their tier one capital ratio up because they're in trouble. The regulators are already putting pressure on them. So here's what I assume, that over the next 10 years, their tier one capital ratio would go from 12.4% to 15.67%. Saying, how do you come up with the 15.67%? 15.67% was at the 75th percentile of tier one capital ratios of all banks. Incidentally, on S&P Capital IQ, you can download the tier one capital for every bank. So this isn't something I had to do a serious amount of research on. You're saying, why do you go to the 75th percentile? If you're a bank with investment banking revenues, you tend to be riskier, your tier one capital ratios to be higher. So over the next 10 years, here's what I'm assuming. Your tier one capital ratio will climb from 12.41% to 15.67%. Now, as the tier one capital ratio climbs, your amount that capital that you will need is basically going to climb as well. So if you look at this change in regulatory capital, they will need to bring in 6.55 billion in new capital, all in equity. Remember, because we're all equity focused in year one. This is not to grow. This is just to get them back to some steady state. So what I'm going to do is I'm going to subtract out this change in regulatory capital from my net income. In year one, because I lose money and I have this additional reinvestment, I end up with a negative free cash flow equity of $11.66 billion. In year two, my net loss becomes smaller, my reinvestment gets smaller, my free cash flow equity gets slightly less negative. But I have negative cash flows for the next 4 years. What does that mean for the next 4 years? Forget about expecting dividends. I'm expecting Deutsche to go out and issue fresh equity to keep going. Once they do that and numbers recover, my potential to pay dividends comes back. This is a model where I'm not looking at what Deutsche actually does. I'm estimating what they need to do to get back to steady state as a healthy bank. I discount those cash flows back to today. Value per share that I got was about $23. Remember last session, we talked about Las Vegas Sands, and after we did the valuation, we stopped and asked, well, what if they don't make it? I asked the same question with Deutsche. And in October of 2016, I had to ask the question. It's not like they're going to go bankrupt. Banks don't go bankrupt, but they can be taken over by the government, in which case your equity can be wiped out. And in 2016, I estimated a 10% chance that they wouldn't make it. Why so low? Because they're too big to fail. I mean, if this were a small bank with these numbers, I'd be putting in a 50% chance that the regulatory authorities will shut them down. With a bank the size of Deutsche, the side costs to everybody else of shutting down a Deutsche and making it go into receivership is so high that others will bend over backwards trying to keep it going. That's why the probability is so low. But in that 10%, my equity is worth nothing. So here's what I have. With the free cash flow equity model to value Deutsche, the value that I get is $23 per share. That's the 90% of the time they make it. But the remaining 10% of the time, I'm getting zero for my equity. My expected value is $20.67. Stock was trading at $13.33. I actually bought the shares and I got lucky because over the next year, they not only did they recover, but they actually made some rights issues of about 11 billion. Why? To cover those free cash flows. So in a sense, they did what I kind of anticipated they'd need to do. Stock briefly went to about $23, $24 per share, but I actually cashed out half my shares at the time of the rights issue. I wish I'd cashed them all out because you know what happened afterwards, right? Remember the horror movie? They found a new basement to go into. They weren't just happy with this. So 2 years later, there was another crisis. Stock dropped to $6. This is a company which every year seems to find a fresh crisis to get through. I mean, right now, the stock's trading at $11 or $12 per share. But basically, it reflects again that with a bank, you have to be creative in estimating cash flows. Any questions on the Deutsche valuation? So basically, it's built around return on equity driving net income, regulatory capital ratios driving reinvestment, and free cash flow to equity as the difference between net income and what you need to reinvest in regulatory capital.
Professor, so if this was a healthier bank, would you then keep Tier 1 capital ratio the same and then grow the risk-adjusted assets?
Unless the regulatory authorities are talking about raising capital ratios, in which case you got to bring it in for every bank. But then I can keep it stable or even lower. There are some banks that are actually so conservatively financed, smaller banks. We can say, why are you keeping an 18% Tier 1 capital ratio? You have the luxury of bringing it down to 16.5%, which means you'll have the capacity to keep paying much more in dividends than your peer group. So even if you're a pure believer in dividends, this now becomes a number that you can look at in addition to the dividends. And I'll tell you why I bring this up, because if you pick stocks based on dividend yields, like a lot of old-time value investors do, for a long time, the list of stocks with high dividend yields are disproportionately financial service companies. A lot of banks show up. And people buy these banks, and the prices don't go up. And 2 years later, they complain that something must be wrong. And my suggestion to them is, why, in addition to the dividends, do you not also download the regulatory capital ratios? Because you want companies, if you are screening on Capital IQ for a good bank, you'd want a bank with a high dividend yield and a high Tier 1 capital ratio, because then you get both the dividends and the safety of knowing that they don't have to raise more equity to keep going.
Thanks. And as a shorthand for banks, if we wanted to value one but didn't want to understand cap ratios and details, can I think that I just need to focus on Tier 1 capital? Is that a fair shorthand to remember?
You are, in a sense. Tier 1 capital then becomes a proxy for how much will they have to reinvest. So if you give me the growth rate in the Tier 1 capital for a bank, I can tell you how much it can afford to pay in dividends in a very rough sense, because those two numbers kind of constrain how much actually gets paid out.
Okay, thanks. And on the Deutsche valuation, on the current year, why did you use the expected ROE to back out net income? Why wouldn't you just
Oh,
use
no,
actual
that's
net
basically, I just did the odds for it. So it says expected
Okay.
ROE, but that's the actual ROE. So the most recent year, it was minus 13.7%. The rest are expectations.
income? Thanks.
Let's talk about valuing companies with intangible assets. Accountants are all fixated on intangibles. What do we do about intangibles? But as we, when you look at discounted cash flow valuation, really there's no difference between tangible and intangible when you think about cash flows. Cash flows are cash flows. But that said, the way accountants account for intangible assets can create problems for you. And here's why. When you do your cash flows and you think about traditional CapEx, you tend to go to the statement of cash flows and look up the CapEx. But with companies which do R&D or have customer acquisition costs, we've already talked about how accounting fails. So you have a lot more dirty work to do where you got to clean up after the accountants. Because if you don't, the returns in equity and returns in capital you're going to compute for this company are in a sense not the true returns in capital and true returns in equity. So you can't even answer the question, is Facebook creating value by growing? Is Uber creating value by growing? So the accounting starts to get in the way. And that's why I kind of fixated when we talked about capitalizing R&D. It's because I want to value companies with intangible assets that I've got to be clearer about what I do with those investments. So let's talk a little bit about what it is that makes this a problem and how it plays out in valuation. And as I said, it's an accounting problem. The way accountants account at companies which have primarily intangible assets is very different and actually inconsistent with the way they account for at companies which are manufacturing businesses. The PE ratio for GM cannot be compared to the PE ratio for Microsoft because the way the accounting is done is different at the two companies. So R&D, customer acquisition costs, exploration costs, consulting firms with human capital investments, those are all things that can get in the way. So, eons ago, I don't know how many sessions ago, we talked about capitalizing R&D, right? So I did this with the valuation of Amgen I did about 10 years ago. So I put a 10-year life on the R&D, capitalize the R&D. And when you capitalize R&D, everything changes. Your income changes, your invested capital changes, basically I did everything. So I worked through the effects. So if you look at my net income and operating income, they both get higher. My return on equity and return on capital both get lower. So in a sense, I'm capitalizing R&D and I'm changing my numbers. But the question is doing all of this going to change your value? Well, in my case, it certainly did. And let's see why. I valued Amgen with R&D capitalized. So when you look at my CapEx, it includes R&D. My operating income is cleaned up for R&D. Everything in this valuation is with R&D capitalized. So if you, in my spreadsheet, say yes to my R&D capitalization, this is exactly what I'm doing to your numbers. I'm making your numbers reflect the fact that you've chosen to capitalize R&D. But here's the bottom line. With R&D capitalized, the value per share that I got was $74.33, well above the market price. It looks undervalued. That's with the yes on the R&D, capitalizing R&D. I then changed the yes to no. You can try this on your company after you capitalize R&D. Take it off the cap. Say, look, if I'd stuck with the original accounting numbers, what my value been? In the case of Amgen, if I hadn't capitalized R&D, the value per share I'd have got would have been $43 per share. So by capitalizing R&D, I'm getting 74. If I'd stayed with the accounting numbers, I'd have got only 43. So the stock could have gone from being undervalued to overvalued. So I have a question. Is this always going to happen at companies? If I capitalize R&D, will I always make the value per share go up? Or is this something specific to Amgen? What do you think? David, you want to give it a shot? Why in the case of Amgen is my value going up when I capitalize R&D?
This David Isom. I guess it would be it's sort of relative to how much you're capitalizing versus how much you would be, think about this, versus how much you'd be
What's a positive effect of R&D? I increase my earnings, right? The negative effect is I increase my invested capital. If my R&D is very effective, here's what you're going to see. My capital will go up and my earnings will go up even more. Amgen had very effective R&D. So if you think of R&D as a capital investment, Amgen was doing very good things in terms of R&D, converting into products. If I did this on Merck, in fact, I did do this on Merck at the same time. When I capitalize R&D, their value per share dropped by about 20%. Why? Because they'd spent a lot of money in R&D, so their invested capital went up. But because it hadn't pushed through into earnings, many of the products hadn't come through, capitalizing R&D there lowered the value. So the bottom line with capitalizing R&D, capitalizing customer acquisition costs, people think that when you capitalize things, you're somehow rewarding a company. That's not true. You're bringing it back into sync, but the net effect of capitalizing will depend on whether what you've capitalized actually creates value to the firm. You're asking of R&D exactly the same question you'd ask of any other investment. I've invested a lot of money. Am I making a sufficient return on that money? With Amgen, the answer was yes. With Merck, the answer was no. Now, one of the things you're seeing now with all these customer-based companies is they all want to capitalize customer acquisition costs. And I'm willing to go along. They think that by capitalizing customer acquisition costs, that'll make them more valuable. That's not true. If you acquire customers, but those customers keep dropping off in 3 months or 6 months or 9 months, and they don't ever spend money on your platform, guess what's going to happen? When I capitalize your customer acquisition costs, your value per share is actually going to go down because you're spending a lot of money acquiring customers and not getting enough value off them. So it's really to bring your investments in intangible assets to the same standards I would use when you invest in tangible assets. Any questions on so try this out. If you have a company where you capitalize R&D, you capitalize customer acquisition costs, turn the yes to a no and see what happens to your value per share. It's a very quick and dirty indicator as to whether your company is creating value or destroying value with all of the side stuff that they're doing. Kushal?
Yeah, so with some of these tech companies and their customer acquisition cost, is that essentially sales and marketing that you look at as a way of acquiring customers?
So if you're asking how much did Uber spend on customer acquisition costs, unfortunately, their selling and marketing is the rough, broad number that I use to come up with the customer acquisition cost. I'll be quite honest. I think user and subscriber-based companies need to have a very different set of disclosures that we don't demand of them right now. I'll give you one example. When you value a Netflix or a Spotify, you know what you'd like to know, right? The renewal rate, because you have these subscribers, you want to know whether 95% of them renew or 85% renew or 7, because that defines how much value a subscriber has. You know how difficult it is to actually get that number? They give you a net renewal rate, but they actually don't give you how many old users drop off and how many new users you added on. That's a fundamental statistic I need to be able to value user or subscriber. So what user-based and subscriber-based companies want to do right now is they want to give you the numbers. Oh, look how many users we have, put a high price on us, but they don't want to give us the information on users and subscribers that should go with that sales pitch. Now, so if you get a chance, I have a paper on my website on valuing users, subscribers, and members. It's not a very inventive title, but it's about how to value a in fact, I use Netflix subscriber, an Amazon Prime member, and an Uber rider as my examples. And I go through the framework for valuing them. It's not rocket science. But then I come up with a list of things I would need to know about users, subscribers, riders to be able to do this well. It's at the end, it's an appendix. And the way to think about this appendix is if you're on Shark Tank and you're the shark and I come up and say, look, I have lots of users, you can go through, okay, how long does a user stay on? What's your renewal rate? How as users age, does the spending change? Do you know that an Uber rider who's been on Uber 3 years spends about 2.5 times more than an Uber rider in the first year, which is good for Uber as a business. Knowing that helps me value riders better. That's the kind of information I would like from these companies, but right now you're not getting it. Any questions on intangible? So don't treat them any differently than anybody else. That's basically the message. Try to treat them like you would building a factory. The fact that you can't see it doesn't mean that you don't focus on cash flows and ask the same questions you would of any other investment. Which brings me to valuing cyclical and commodity companies. You value a commodity company or a cyclical company. There's always somebody else in the room while you're telling your story. And let me explain. When I look at ExxonMobil and say, what are your cash flows from existing assets? I can look at the financials, right? But looking over the shoulder of ExxonMobil is oil prices, because if oil prices are high, those numbers are going to look great. If oil prices were low, those numbers are going to look terrible. When I look at what's the value of future growth, if oil price are 80, everything looks good. If oil prices drop to 40, nothing looks good. The value of growth can be a function of what the oil price is. And ask you, how risky are you as a company? At $80 oil prices, you're flush with cash. You have no trouble making your debt payments. I lower oil prices to $40, all of a sudden you're in default. You worry about you're not making it. And when I ask you, when will you be a mature company? If oil price at $80, you say, I can grow for the next 10 years. But if oil price at 40, you're saying, I'm done, nothing more I can do. Every question about the company, you see a macro component, which is what the commodity price is, what the economy is doing, driving the answer to that question. So I'll start with stating the obvious. When you value commodity or cyclical companies, you will be tempted to make macro assumptions. You know what I mean by that? When you value an oil company, you feel this urge to forecast oil prices. When you value a cyclical company, you'll feel this urge to try to forecast what the economy will do in 2021 and 2022. It's human nature. And I want you to fight that urge, because if you give in, you've lost control of your valuation. Let me explain. Let's assume Hakan is valuing ExxonMobil. Hakan, do you have a strong view on oil prices going forward?
I think it's gonna drop.
Okay, so I'm going to make it a strong one. Hakan believes oil prices will drop 50% over the next 5 years. That might not be a view, but let's say it is. Let's say you build in that view when you value ExxonMobil, that oil prices, which are right now around $60, are going to drop to 30 over the next 5 years. What are you going to find at the end of your valuation? What are you going to find at the end of your valuation? That ExxonMobil is cheap or expensive?
Expensive.
Yeah, because you've knocked oil prices down 50%, the cash flows are going to drop, the earnings are going to be terrible. You're going to say, don't buy the stock. In contrast, if you believed oil prices are going to double over the next 5 years, ExxonMobil is going to look cheap. You're saying, so what? If you're that good at forecasting oil prices, what the heck are you doing valuing ExxonMobil? There's a far easier way for you to make money. What did you do? Go buy oil futures. When you build in your predictions of a commodity price into a company, you're messing up your valuation. You're making it a joint product of what you think about the commodity and what you think about ExxonMobil. Here's what I'd prefer you do. Give me a forecasted oil price as a separate document. Say, look, this is what I think will happen to oil price in the future. That's going to drive whether I invest in this sector. And then when you value ExxonMobil, here's what you want to try to do. You want to make it as oil price neutral as you can. In other words, you can say, given what oil prices are today, I think ExxonMobil is cheap or expensive, because now you can decide as an investor how you use the oil price forecast you gave me. And that might mean I put only 3% of my money in energy stocks. But once I've decided to do that, whether I buy ExxonMobil or not will depend on the valuation you did with that oil price neutral valuation. It's really difficult to do, because you constantly, it's very difficult not to think about oil prices. And just to show you how much this can matter, I'm going to show you my valuation of Royal Dutch, and you're going to see how much the oil price drives its numbers. It's obviously driving it. And you're going to say, what if it changes? That's why we have probabilistic tools. I've used Monte Carlo simulations a couple of times already, but with commodity companies, I draw on it almost every time I value a commodity company. And what I do is I make the commodity price a distribution, because the reality is it could be $55 today, it's oil price per barrel. It could be 70 tomorrow, it could be 35 the day after. let it be drawn from a distribution. So here's a company, Royal Dutch, and you can see my valuation in March of 2016. And I'll set the table. In March of 2016, the oil price had dropped to $40 a barrel. From what? From about 70 in the previous year. And here's the problem I ran into. When you value a company, what do? You take the trailing 12-month numbers, right, as your base year. I looked at the trailing 12-month numbers for Royal Dutch, and I said, you know what? There's no way they're going to make these numbers, because these numbers reflect a $70 oil price. Oil price are down to $40. I need to estimate what the revenues will be at a $40 oil price. I almost have to restate the trailing 12-month numbers to reflect where oil prices are today. This is actually a problem that you will face today if you value oil companies, because many of them in the middle of 2020 saw $30 oil prices. So their trailing 12-month numbers reflect a much more pessimistic view of oil prices than where oil prices are today. So being oil price neutral doesn't just mean not taking a point of view on oil prices. It actually means restating the numbers to reflect where oil prices are today. The revenue I came up with, the $40 oil price, was about $201 billion. What I actually did was I looked at the last 40 years of Royal Dutch revenues and the last 40 years of oil prices. And I looked at how much a dollar change in the oil price translated into revenues for Royal Dutch. I mean, 96% of the variation in Royal Dutch revenues comes from changes in oil prices. It's that close. So if you give me the oil price, I can predict the revenues, and that's what I'm doing here. That 201.5 billion in revenues was about 15 billion lower than their trailing 12-month revenues. But the reason I'm using the lower revenues is to reflect the lower oil prices today. So I'm building off a much lower base number to reflect that oil prices are low. But with that base number, the value that I got per share was about $39. The rest of the valuation is pretty straightforward. I do margins and growth, but I'm building off a base year that reflects today's oil prices. So if I took Hakan's point of view and oil price we're going to have, what you're going to see is a dropping in revenues over time because I'll be getting less per barrel. Here I'm building in the expectation that oil price will stay around $40 a barrel. The value per share was $39, the stock was trading at 42. I actually did this for a group of people at Royal Dutch, and after I was done, one of the, this was the finance group in Houston, again, did in London. Now, one of the people in the audience put up his hand, and he said, no, but oil prices could change. And I said, I know. He said, what do we do about this? And I said, nothing much in a base case valuation, but if I really wanted to do something about this, and this is what I meant about how much Royal Dutch's revenues and oil price are linked. Take a look at the blue column is the revenues per year. The brown is the average oil price. Look at how closely the two move together. 96% of the variation in revenues comes from changes in oil prices. When I invest in Royal Dutch, if you ask me who the CEO of Royal Dutch is, you know what my answer is going to be? I don't know, and I don't care. What's he going to do anyway? Come watch the terminal a little more closely and make the oil price move. This is an oil price play. And by looking at history, I can give you a measure then of how much revenues will change as oil prices change. And that's what I'm going to use to actually do a richer valuation of Royal Dutch. So I took Crystal Ball, the Monte Carlo simulation tool you can use with Excel. And what I fed into Crystal Ball was not, so my oil price was $40 a barrel, but given that oil is a traded commodity, I was able to feed in a distribution of oil prices based on oil prices over the last 30 or 40 years. So this distribution was what you start with. So let's see how the simulation would work. The oil price today is 40, right? The computer goes into the distribution and picks an oil price out of the distribution. The first pick it comes up with is $52 a barrel. I value Royal Dutch with a $52 oil price. Because remember, if you give me the price, I can come up with the revenue. If you give me the revenue, I can come up with the operating. So basically, I let the oil price change. I value the company. Then the computer goes and picks the second price out of the distribution, $35. I value Royal Dutch at the $35 price. I do this over and over and over again. The default in Crystal Ball, I think, is 10,000 simulations. It takes it about a minute to do. It's actually magical. The distribution actually, you see it kind of forming in front of you. And when it's done, it comes back with a distribution of values per share. And obviously, the values per share vary because depending on the oil price, Royal Dutch could be worth $60 a barrel or $20 a barrel. You say, what do I do with this distribution? When you have distributions, rather than just give me an expected value, you can give me percentiles. So if I look at the distribution, the 10th percentile of value is about 24, the 90th percentile is 57. 80% of the valuations lie between 24 and 58. The median, of course, is very close to my base case, $37. What did I say the stock was trading at? $42 per share. At $42 per share, if you ask me what I thought about the company, I'm going to say it's overvalued, but I can tell you more. I'll tell you there's a 65% chance it's overvalued, somewhere between the 60 and there's a 35% chance it's undervalued. Using a distribution can enrich your choices. In the case of a commodity company, because so much of my value rides on what the commodity price does, this becomes a very effective way of asking and answering that what if question. What if prices change? You can see the effect on value and decide what to do. Any questions on commodity companies and keeping your views out as best as you can? It's very difficult to do. I won't tell you it's easy, but you want to avoid making forecasts of commodity prices that are yours and making it part of your valuation of a commodity company, because then you mix together two things, your views in the commodity and the views in the company. David?
Yeah, do you ever use future prices?
You
that are
could.
traded
And
futures?
with storable commodities, though, there's very little information in the futures price. You know, the futures price of oil is always, right? It's a spot price plus the storage, plus the storage cost. And so with futures contracts, it's different if you're doing a commodity like pork bellies, right? You can't store pork belly. So the futures price of pork belly is actually an expected price on what people think the price will be a year or 2 years from now. But with most storable commodities, which is what these companies are built around, futures prices don't give me much more than the spot price adjusted for storage costs and interest expenses. Any other questions? So let's close this intrinsic value section. Let's think about how this is going to play out. What we're going to talk about next is pricing. So everything we've done, and we're in session 16 of the class, is about getting value, cash flows, growth, and risk. And what we're going to talk about next is pricing. And the difference is what every investment philosophy is built on what you think about the value in the pricing process, what I call the gap. In fact, when you think about pricing and value, the key difference is to think about what we're trying to do. When you're pricing something, you look at what other people are willing to pay for similar things. Now, and I like to use the example of real estate, right? If you go on Redfin or you look at whatever site you go to look for real estate, you say, how much am I going to pay for an apartment in New York? You can look at other apartments in the neighborhood, the pricing. Now, Zillow, in fact, is this, what is it, Z estimate? Is that what they call it? Which is actually a kind of an automated pricing where they use the sales in the neighborhood just for the number of bedrooms you have. And it does actually a pretty good job relative to the typical realtor in terms of coming up with a number. Real estate is all pricing all the time. And if you think equity research is different, think again. Equity research is pricing as well, because if you look at most equity research, if there's a buy recommendation, it's based on a multiple and comparables. Basically, you're told a stock is cheap because it trades at 12 times earnings, and other companies just like it trade at 20 times earnings. Pricing is more common than you think. And that's why we're going to spend about 6 or 7 sessions on talking about doing pricing right. But it's very different from the value process. So as a kind of closing thought for value, think about the 4 questions that every valuation tries to answer: cash flows, value of growth, risk, and when will you be a mature firm? It's a framework we use to look at the dark side of valuation. Those are the drivers of value. The drivers of price, on the other hand, tend to be demand and supply, mood and momentum, liquidity. You've been reading the story of the Chinese family office that ran into trouble using a lot of leverage, bought stocks like Viacom, and I think of quite a few of the Chinese tech companies. And now Credit Suisse is having to liquidate those stocks because they need to get the money back to pay off the leverage. Viacom was down 20% last week. Saying what happened to its value? Nothing happened to its value. But it affected the price because you have that much selling, liquidity gets affected. And the pricing process is driven by what I call incremental information. Small things that you look and say, really, that makes that much of a difference? Earnings per share being 2 cents higher than expected. The value process is driven by cash flows, growth, and risk, the business model you built. The pricing process is driven by more transient things that can change over short periods. So when you look at that gap between price and value, there are 3 views you can bring in. The first is you can say, what gap? If you believe in efficient markets, that's exactly a reaction, right? There, what gap? They're the same. In which case, your investing philosophy became very clear. If you believe markets are efficient, what do? You buy index funds, and then you go back to living the rest of your life. Not an unhealthy way to actually invest. It's kind of. If you're a value extremist, now these are the people who show up in Omaha and believe that their way is the only right way. Here's what you believe: that you come up with the value, the price is always wrong, and the price will move to value. So basically, you buy and hold when the value is higher than the price. But at the other extreme, you have what I call pricing extremists. These are pure traders. They don't think value even matters. Their entire game is, what's the price today? What will it be a day from now? Who really cares what the cash flows, growth, and risk are? So you'd be buying GameStop, you'd be buying Tesla, you'd be buying Bitcoin if you think the price is going to move in your direction. One of the classes I don't teach at Stern is an investment philosophies class. Investment philosophies class is all about, what do you think about this gap? Is there one? Because being clear about what you think about the difference between value and price is at the foundation of every investment philosophy. But each group has its own issues, right? If you look at pure traders, they have no anchor. If you ask a trader, where should the price stop? They have no basis, nothing to give them an anchor. So they basically are going to react to whatever's going on around them. And their biggest weakness is they're entirely at the mercy of the crowd. You imagine how much you've been swung around as somebody trading on GameStop, because this has nothing to do with you, right? This is something to do with the crowd and what they think today and where the price will go. So price's dilemma is there's no anchor, you're reactive, you're at the mercy of the crowd. That's what every trader faces. In contrast, if you're an intrinsic value person, and some of you might decide that intrinsic value is the way to go, you have your own issues. The first is, you're never certain. You think there's a gap, but you're never sure, right? Because you came up with the value, you could be wrong about growth and margins and reinvestments. You're uncertain about the value itself. And to counter this, old-time value investors have come up with their own mechanisms for dealing with that uncertainty. One is what's called margin of safety. Old-time value investors make a big deal about this, that if there isn't enough margin of safety, that they will not invest in a stock. Put simply, a margin of safety is the difference between price and value. So if you have a margin of safety, rather than saying I will buy undervalued stocks, you say I will buy undervalued stocks if the difference is more than 20% or 25%. That's the margin of safety. The second thing that people try to do to deal with uncertainty is they try to collect more information. In my experience, that never reduces uncertainty. It actually makes it worse. So if you think collecting more information on your company is going to make you feel more certain about the valuation, be my guest, try. But come back in a week and tell me whether you feel more certain. Because as you collect that new information, new questions will open up. The third is, after you're done with the evaluation, you can ask what if questions, right? What if my growth were higher? What if my margins were lower? It's easy to do with Excel. And the fourth is, you bring in that uncertainty into your distributions. That's what a Monte Carlo simulation does. It said, look, I feel uncertain. This is how uncertain I am. So if your uncertainty is about value, there are tools to deal with that. But there's another uncertainty, and this is something that you don't control. For you to make money, the gap has to close, right? Because if you bought something and the price is less than the value, the gap has to go away. And you don't control that process. Well, if you're a small-time investor, one way you can increase your odds or improve your odds is to have a longer time horizon. It gives the market more time to correct its mistakes. The other is maybe you can be the catalyst that causes the gap to close. See, what are you talking about? Now, have you noticed that when Carl Icahn or Bill Ackman take a position in a company, what's the first thing they do? They get on CNBC, they make themselves vocal, they want to tell you that they bought this company. They're trying to act as catalysts. Because if you then act based on what they're telling you, the gap closes, they make their money, they can move on. So the catalyst approach, you're looking for something that you can do to change it. But unfortunately, I cannot be a catalyst. Maybe you can if you have billions of dollars, I don't. So I look for things that could be potential catalysts, something that can cause the market to reassess value. Like what? Maybe you can look for a management change, because when you have a management change, companies get a new look. Maybe a big shareholder coming into the company. So you're looking for something you can latch on to say, this is what's going to cause the gap to change. Because the alternative is essentially say, look, I don't control it. I'm going to sit back and wait for it to happen. I call this the karmic approach. There is the gap and it will close, but I don't know when. It's not under my control. What I'm trying to prepare you for is that decision that you have to make on your valuation is a lot more difficult than you think. You might have dotted your I's, crossed your T's. You think you've got everything nailed, but there are still so many things that are out of your control. So value versus price, just to illustrate how dynamic these processes are. I valued Apple every year since 2010. I'll start with a confession. I love Apple as a company. So this is a company where I bring in those biases. So you see my valuations from September 2011 to September 2019. I should add the September 2020 number in there. And each year you'll see my value per share and the price per share. In September 2011, when I valued it was undervalued by 21%. In September 12th, when I valued it, was overvalued by 4.4%. So basically you can see both the price and the value changing, and you can see the stock going from being undervalued to overvalued to undervalued. I mean, on Apple alone, I bought the stock 5 times in the last 10 years and sold it 5 times, because it seems to be a company where people go through these phases. And the phases are usually tailored around the next iPhone, because this has become a smartphone company. So a new iPhone will come out. If it sells better than expected, here's what people seem to think. Apple's back to being a growth company. It's going to grow 20% a year. They push up the price too much, and they set themselves up for disappointment. If a new iPhone comes out and it doesn't sell, people say, this is the end. We'll never get a cash flow. They sell off everything. So Apple goes up and down depending on where the new iPhone comes in. Now, for some people, that's frustrating. So I prefer... Now, to me, it's an opportunity, because every time markets overshoot, I'm going to be selling. And every time market undershoot, I'm buying. And because it's a company that's fairly easy to kind of understand as a base company, it becomes easier to play this game. Investing is not buy and hold forever. It's buy, maybe sell, buy, maybe sell again. And you can see the numbers play out as you go through time. So I'm going to close this packet with with a picture from one of my favorite movies. You recognize it, right? It's The Wizard of Oz. If you haven't seen the movie, you should. It's a really long movie, but it's a movie. I'll tell you the story. Don't jump on me for telling an unrealistic story. This is a story of a girl called Dorothy who lives in Kansas, and she gets sucked up by a tornado and dumped into Oz. I didn't make up the story, somebody did. And she lands on top of the witch. I keep forgetting which way, which from the west or which from the east, but she kills the witch, facing homicide charges. This is how the movie begins. It's a very traumatic movie. So if little kids, don't let them watch the first 10 minutes, they will never recover. And Dorothy wants to get back to Kansas. So she turns to this munchkin standing by the side of the road, says, how do I get back to Kansas? Why she wants to go back to Kansas, I don't know. I'd have just stayed in Oz. But I guess she wanted to go back to Kansas. And of course, the munchkin says, you got to go see the Wizard of Oz. He has the answer to every question. And she says, how do I get to the Wizard of Oz? He says, follow the yellow brick road. And for the next 3 hours, it's a really long movie, I told you, she hops and she skips. She never walks a step. If you don't believe me, watch the movie. She hops and she skips. And along the way, she collects a motley crew. Scarecrow, a Tin Man, a lion. The lion wants courage. The Tin Man wants a brain. The Scarecrow wants a heart. I mean, each of them wants something. And each of them is told, just go see the Wizard of Oz. He has the answer to everything. So 2 hours and 50 minutes later, this crew shows up at the Wizard of Oz's big, whatever that room is, they show up. And they can't see the Wizard of Oz, he's behind a curtain. He says, what are you here for? And they each tell the wizard what they're here for. The Dorothy says, I want to go back to Kansas. The lion says, I want courage. And the wizard says, come back tomorrow. It's like a DMV office, I guess. And they said, we've come all this way just to ask you this question. To come back tomorrow. At that point, the curtain falls. And what you see behind the curtain is not a wizard, but this small guy pulling, there was no Wizard of Oz. But here's what the movie's message is. Each of them got what they wanted on the journey. Dorothy got these red shoes. All she needed to do was click the red shoes. She was back in Kansas. The lion fought off some bad guys. He got the courage by fighting them off. The message was, the wizard didn't have the answers. You got the answers on the journey. You're saying, what's this got to do with valuation? There are all these questions that you run into, right? You sit down to value a company. Should I use an effective tax rate or a marginal tax rate? So what do? You go on a Google search mission. Should I use effective or marginal? You think there's somebody out there who has the answer to all these questions. What I'm trying to tell you is, the answers are within. As you work through valuation, you will get the answers to these questions by working through the process. So as you run into questions valuation, rather than look outward and say, somebody must have answered this question again, try answering the question yourself. Because that's how you acquire the tools to deal with the next question you run into. Intrinsic valuation is not difficult, but it does require that you be creative at times and not fall into these, this is the way I've always done things, this is where I will continue to do them. So any questions on intrinsic valuation before we close? So I'm at least going to get started on the second packet. If you don't have it, don't worry about it. No. But basically, I want to get started on the pricing process. So let's start at the basis of pricing. So far, whenever we talked about valuation, we went to business models and cash flows and growth and risk. In pricing, you ask a different question. You're saying, if I were going to put a number in an asset, how would I come up with that number? You look at what other people are paying for similar assets. That's the essence of pricing. So if you break down pricing, there are three ingredients you're going to see. The first is, to price something, you've got to find other things just like it, right? Similar assets, comparable assets. To price a Picasso, you've got to find other Picassos. To price a house, you've got to find other houses. To price a seat in Yankee Stadium on StubHub, you got to find other seats close to that seat that's sold and see what other people pay for it. So you need to find similar assets. If you're looking at shares, you got to standardize prices. Why? Because you can't compare the market cap of a small company to a large company. You standardize, which is a fancy way of saying you divide the price by something. Price by earnings, price per book, EV by EBITDA. A multiple is just a standardized price. So you find similar assets, you standardize the price, and then you have to control for differences. And I'll make this much simpler. Let's say you are a person who buys commercial real estate. You're looking at how much you should pay for a building. You find two other buildings in the neighborhood that have sold recently. In order to put a pricing on this building, the first thing you're going to do is, you can't just look at the price of those buildings because they might have 15 or 20 stories and you have only 11. You might look at the square footage in the building. So you look at the price per square foot you paid, that was paid for those buildings, and attach it to the square footage on your building. And then you got to factor in that your building is a lot older than those two buildings. It requires a lot more work. What will that mean? You'll pay a lower price for that same building. You control for differences. Find similar assets, standardize the price, control for differences. So I'm going to start with a statement about pricing that I will back up. Much of what passes for valuation out there in equity research and M&A, in venture capital, is really pricing. Let me back that up. About 20 years ago, I collected about 550 equity research reports from around the world. I'll make a confession, I didn't read most of them, but I collected them because I wanted to classify how equity research analysts came up with a number for their companies. How do they come up with the buy recommendation, the sell recommendation? Out of the 550 sell-side equity research reports, 45 were based on discounted cash flow valuations, less than 10%. The rest were based on multiples and comparables, and basically they were pricings. Equity research is almost always pricing, not intrinsic valuation. Why your job as a sell-side analyst is to give me buy or sell recommendations relative to other companies in the same group. I wasn't surprised. 85 to 90% of sell-side equity research is pricing. I said, maybe it's different in M&A. So I was able to get my hands on about 100 acquisition valuations. It's actually very difficult to get your hands on, because when bankers do M&A valuation, they go into a vault. I think they burn them or destroy them because they don't want anybody to see the forecast that they originally made to justify an acquisition. But I have my sources, and I was able to get 100 acquisition valuations. And at first sight, it looked like it was 50-50. About half were in pricing and half looked like DCFs. Until I took a closer look at the DCFs and discovered that most were pricing and drag. Why? Because the biggest number in the DCF is the terminal value, and in many of these DCFs, the terminal value came from using a 6 times EBITDA multiple or a 10 times earnings multiple. It was pricing and drag. This was 20 years ago, and after I was done with this, I was a little surprised that so much of what I was looking at was pricing. And here's why. One of the questions I'm going to ask you at the end of this class is a question you saw in the very first class. And I said, hold off on answering this question after you've tried it. The question I want to ask is, as you leave this class, since you now have seen how intrinsic valuation works and how pricing works, if you had to pick, which one would you pick to put a number on a stock? In the 40 years of teaching this class, that breakdown has always been about 70, 20, 10. As people leave my class, if I ask them which of these approaches do you pick, about 70% pick intrinsic valuation, about 20% pick pricing, and the remaining 10% become believers in efficient markets after they value one company. So this was really not easy. But 7 to 2, when they leave my classroom, they're telling me that they believe in intrinsic valuation over pricing. I'll wager if I track these people down 5 years later at whatever job they have, bankers, consultants, analysts, and I say, hey, now that you're at your desk, how are you putting numbers on companies? I'll wager the numbers get flipped. So they go to 70% pricing, 20%. There's something out there in the process that drives people away from intrinsic valuation to pricing, and be prepared for it. You can go out there as the firmest believer in intrinsic value, and 5 years later using PE ratios and comps to make you pay. So I've been thinking for a while about what it is about this process that makes pricing so attractive. Now, one came to me while I was watching a Seinfeld episode. You've seen Seinfeld, right? Quintessential New York sitcom. And in this episode, one of Jerry's girlfriends accuses him of being crazy. He said, Jerry, you're crazy. And in response, he says, if you think I'm crazy, you should see the guy who lives across the hall from me. If you've never seen a Seinfeld episode, you have no idea what I'm talking about. But guess who lives across the hall from Jerry? A guy called Kramer. And relative to Kramer, who's crazy? Everybody looks sane. You say, what's this got to do with pricing? We forget how much of putting numbers in companies is driven by the need to sell something. You're selling a company, you're selling a piece of property. It's easier to sell something with a pricing than with a valuation. You know why? All you need to show me is that there's something else out there that's even more expensive. So if I tried to sell you a stock at 100 times earnings, and you say, that looks really high, you know what I do? I show you 3 other stocks that trade at 300 times earnings. So relative to those stocks, this looks cheap. Pricing is relative, and it's easier to sell something with a pricing than a discounted cash flow valuation. Second, it's easier to defend a pricing than to defend an intrinsic valuation. Think of why. When you do an intrinsic valuation, your insides are out there for everybody to pick apart, right? They don't like your beta, they don't like your growth rate, they don't like your cash flows, they don't like the fact you use 10 years of forecast. But if instead I told you, look, I think Amgen is cheap because it's trading at 6 times EBITDA. And you asked me, why 6? I said, that's what other pharmaceutical companies trade at. Think of the target I've given you. It's tiny, right? You don't like 6 times EBITDA. My response is take it up with the market. It's not my fault. I'm just the messenger here. It's so much easier defending a pricing. That's why when you look at road shows for IPOs, bankers always talk in terms of pricing. This stock is cheap. It's trading at $100 per user. Everything else trades at $150 per user. It's easier to sell, it's easier to defend. And here's the final reason I think pricing wins. I think with both pricing and intrinsic valuation, you're going to be wrong a substantial percentage of the time. Let me put some numbers. I think you're going to be wrong about 40% of the time with intrinsic valuation and about 45% of the time with pricing. 40 is better than 45, right? So you're saying that drives me towards intrinsic valuation. But here's the catch. When you're wrong with intrinsic valuation, you're far more likely to be wrong alone. Let me explain. The nature of intrinsic valuation is you're often going against the crowd. You're buying when everybody else is selling. You're selling when everybody else is buying. Right? It's the nature of intrinsic valuation. You're saying, so what? If you're wrong with intrinsic valuation, you're also far more likely to be wrong alone. In other words, you're buying when everybody else is selling. If the stock keeps going down, you're wrong alone. He's saying, so what? You know what happens to people who are wrong alone? They get fired. Survival alone will force you towards pricing, because if you make a mistake with pricing, you're always going to have lots of company. This is a long lead-in. But 30 years ago, when I used to teach this class, I used to try to talk people out of using pricing. I said, so much better to do intrinsic valuation, reflecting my biases. I no longer do that, because many of you in your jobs will have a pricing job. You'll have a pricing mission. So what I'm going to talk about over the next few sessions is doing pricing better, right? Because pricing is what you have to do if you're a portfolio manager, because you're judged against other portfolio managers. Pricing is what you do if you're a sell-side equity research analyst, because you have to put a buy recommendation in whatever sector you're in, even if everything looks overvalued. Pricing is what you have to do if you're an M&A banker, because you've got to get the deal done. So next session, when we start, I'm going to start off by kind of breaking down a multiple, look at what goes into a multiple. And then I'm going to go through a 4-step process for breaking down pricing, a way to do pricing better, a way to be more sensible in your pricing. And if you follow the 4-step process, uncover these P ratios, EV to EBITDA, EV to sales, you will at least ask the right questions before you start pricing companies. So I'm going to stop there, and next session we'll start with what a multiple is, how we standardize prices, what our choices are, and we'll go through that 4-step process. Any final questions before I sign off? Okie doke, I am going to sign off, and I will see you on Monday. So again, reminder that you don't have to turn in the DCF until Sunday. So I've extended the deadline. If you get finished earlier, please send it. But if you're not finished by Friday, you can use the extra 2 days if you want, see if you can get the DCF done. And do your best to kind of make it as complete as you can, so you're not sending me a completely raw worksheet where you're just making up stuff as you go along, because then the feedback I get will be less useful. But I will talk to you on Monday.